The rule isn't written anywhere. You won't find it in a textbook, no politician campaigns on it. But it decides, quietly and consistently, who gets richer during inflation and who never does. When prices rise, we're told everyone suffers. Milk costs more, rent jumps, fuel burns a hole in your pocket. That's the story. It's comforting, and it's incomplete. Because inflation does not hit everyone equally. In fact, for a small group of people, inflation is not a problem at all. It's an upgrade. This matters right now because inflation isn't a temporary glitch anymore. It's becoming a permanent feature. And the quiet rule behind it is reshaping wealth faster than salaries, faster than promotions, faster than hard work ever could. Let's strip this down to the simplest possible level. Imagine two people, same city, same inflation, same year. One owns assets, the other earns income. That's it. That's the split. Assets are things that hold value or grow: property, stocks, businesses, bonds, land. Income is what most people live on: salaries, wages, fixed payments. Inflation enters the picture like a flood. But here's the catch: assets float, income sinks. This is not philosophy, it's math. Inflation means money loses purchasing power over time. Each unit of currency buys less than it did before. Now ask a simple question: who touches new money first? Because new money is always created during inflation. It doesn't appear evenly. It enters through specific doors: banks, governments, large institutions, asset markets. By the time it reaches salaries, prices have already moved. This is the quiet rule. Money benefits the people closest to its source. If your wealth is tied to assets that reprice quickly, inflation works for you. If your life depends on income that adjusts slowly, inflation works against you. Let's make this uncomfortable. When inflation hits, companies raise prices fast. Asset prices react almost instantly. Stock markets adjust. Real estate reprices. But wages lag, sometimes by months, often by years, sometimes forever. So while prices move forward, income stays stuck in the past. This is how inflation transfers wealth without anyone signing a document. Now comes the part most people miss. Debt flips sides during inflation. If you owe money, inflation quietly helps you. If you are owed money, inflation quietly hurts you. Imagine you borrowed $1 million at a fixed interest rate. Inflation rises. The real value of that debt shrinks. You still owe $1 million on paper, but in purchasing power, you're paying back less. The system doesn't announce this. It just happens. This is why governments tolerate inflation, sometimes even encourage it. Governments are the largest debt holders on earth. Inflation is the only tax that doesn't need legislation, it doesn't need votes, and it doesn't look like theft. It looks like prices going up. Now contrast that with someone holding cash. Cash is a promise frozen in time. Inflation melts it. No drama, no headlines, just erosion. This is why saving money feels harder every decade. You're fighting a current that never stops flowing. Here's the irony. People who need money the most are told to be careful, save, avoid debt, play safe. People who already have money do the opposite. They borrow, they leverage, they buy assets. Inflation rewards the second group, not because they're smarter, but because the system is built that way. Let's talk about housing for a moment. When inflation rises, central banks eventually raise interest rates. That's the headline. But before that happens, property prices often surge. Why? Because houses are assets. They absorb inflation early, so homeowners watch their net worth grow on paper. Renters watch rents rise in reality. Same inflation, opposite outcomes. This creates a strange social illusion. It looks like some people are winning because they made better choices, but very often they just stood on the right side of the rule. Now zoom out. Inflation doesn't just separate people, it separates generations. Older generations bought assets when prices were lower and debt was cheaper. Younger generations enter when prices are already inflated. Same work ethic, different starting line. Inflation quietly locks this gap in place. And then comes the hype. You'll hear about beating inflation, outperforming it, timing markets, finding the perfect investment. That noise distracts from the core truth. You don't need genius returns to win during inflation. You just need to be positioned correctly. Assets that reprice faster than consumer prices, debt fixed in nominal terms, income streams that adjust automatically. That's it. Everything else is optimization. Now the uncomfortable part. Most people cannot reposition easily, not because they're lazy, but because access itself is unequal. You need capital to buy assets, you need credibility to borrow cheaply, you need stability to take risk. Inflation amplifies these differences. It doesn't create inequality, it accelerates it. This is why inflation feels chaotic, but produces very consistent outcomes. The same groups benefit, the same groups fall behind, every cycle. Now let's add one more layer. Inflation changes behavior. When people expect money to lose value, they stop saving, they rush to spend, they chase assets. This pushes prices even higher, which forces policymakers to react, usually late, often aggressively. And when they do, the damage doesn't fall evenly either. Asset holders can wait, income earners feel it immediately. Job losses, credit tightening, recessions. The cycle resets, but the rule remains. And it's quiet because no one needs to explain it. The system enforces it automatically. So, here's the final question. If inflation is becoming a permanent feature of modern economies, if debt keeps growing, if money keeps losing value by design, then what does getting ahead even mean anymore? Is it about working harder, earning more, saving better? Or is it about understanding where you stand relative to the flow of money itself? Because as long as inflation exists, the rule doesn't change. It just keeps deciding, silently.